This is Daybreak Asia. We're counting down to Asia's major market opens as markets come online in the next sort of few minutes or so. And Paul, unsurprisingly, we're getting a pretty weak follow through here in Asia. And it's interesting, we're seeing this kind of string of weak treasury auctions really start to affect sentiment across other asset classes, be it you talk about commodities or clearly the weakness that we're seeing in equity sentiment as well.
Yeah, it was a very rough day for Aussie bonds yesterday as well. The beige book that we got out of the US, well, that was, showed a slight to modest positive outlook for the economy going forward. Yeah, we've still got bets for rate cuts this year. It'll be interesting to see if they get repriced as well.
We do, and we have just heard from the Atlanta Fed President Raphael Bostic. Look, a little bit of a foot in both camps, right? Saying that the fourth quarter might be when the Fed will start looking at cutting, but really they need to see further evidence of disinflation, and that some elements that they're seeing are still sort of quite concerning as well. So again, the messaging is they're not in a hurry. They want to see more. That is not going to be something that gives joy to these markets, right? The Nikkei right off the bat we're off by about 1%. There's some weakness across the topics there as well. Dollar yen is the interesting one, 157.61, clearly beyond the point where we thought perhaps there would be some concern at 157, 52 were the levels I believe we were looking at, and perhaps now the question, as is our question of the day, is what happens if we do get to 160 and beyond that? Do we see another risk of intervention there as well? So weakness sort of across the board, but take a look at what we're seeing at the first couple of minutes or so of trading in Korea as well. Some of the sort of tech earnings overnight, the likes of HP, for example, were quite positive, and we could see a little bit of follow through in the Asian session with the sort of tech and software and hardware related names there. But the Kospi at this point also seeing a little bit of underperformance, although not quite as steep as the levels that we're seeing elsewhere, Paul.
Well, we've just opened here, of course, in Australia as well. Staggered open here, so hard to get a read on things. The market kind of flat at the moment. But BHP has begun trading, seeing a little bit of weakness there, off 1/3 of 1%. This is after, of course, BHP walked away from its bid to buy Anglo American. 5 weeks that took. It's not happening. BHP shares just retreating a little bit in the early going. Elsewhere, we've got trading open for US debt. We've got the 10-year 462.57 at the moment. We did see yields advance after a fairly weak auction. That beige book that I mentioned forecasting slight to modest growth in the US economy. A little bit of strength there for the Aussie dollar as well.
Let's get some more with Garfield Reynolds, who leads our Markets Live Asia coverage. And Garf, certainly for Japan, but more broadly, are we getting to the point where rising yields are really starting to create a risk for the equities rally?
Yeah, that is clearly what's happening. In the initial moves higher and the recent path up for Treasury yields, equities seem to be mostly, the calculation was that higher yields are part of a stronger economy. Stronger economy is good for earnings. Nvidia earnings came and went, and they were very good, and Nvidia rallied a lot. The problem was, though, that we had what was a very narrow equity rally for quite a while, with the Magnificent Seven being about all that was gaining. Now we're looking at something where it's almost only Nvidia that is gaining, or you can be sure is gaining, and that's also starting to have an impact. So the calculation seems to be, unless you are something like Nvidia, where you've got an extraordinary case for gains, then you're under pressure.
But we saw Japan yields slipping as well, and we've got a yen back in focus again, nudging back towards that level where we think we saw intervention last time. This is the question of the day, right? What happens if we get to 160, and is the BOJ going to do something first?
Well, the way we're trending now, 160 should be a week or two away at most. It could even get considerably closer if US data tonight and then Friday night come in hot. That could really ramp up expectations for a hawkish Fed at next month's FOMC. So yen weakness is on the table, and on the one hand, the yen's declines, the increase in the dollar-yen rate that's taken it past this former apparent intervention level, has been slow. And Japanese authorities have made it clear the main trigger for them is too rapid depreciation. So that would argue against them intervening. Then again, that apparent intervention at the end of last month came at 160.17, which was just 0.03 shy of the lowest back in 1990. So it's a significant psychological level, along with the round figure of 160. If it gets there, it would be hard to see them just walk away, like not do anything. And we don't have a BOJ meeting for a couple of weeks yet. So I suppose the BOJ could adjust bond purchases down. That could happen. They could amp up the rhetoric. They're certainly going to face a lot of pressure to normalise policy. But we could also, FX traders definitely are going to be nervous about the potential for intervention. We could see some sudden moves, even if people just think that it's coming. And considering, that the last time that it apparently happened was in the US session when there was an impulse for the yen to weaken anyway. So I mentioned those risky data releases tonight and tomorrow night. If those come in softer than expected, you see the US dollar weakening, you would think there would be the temptation for the Japanese Ministry of Finance to say, okay, perfect chance to knock it down. We saw some shorts reinitiated over the last couple of weeks, so they could try to squeeze them. Either way, we're looking for the potential for some turmoil in the Japanese yen.
All right, Garfield Reynolds there, who leads our Markets Live Asia coverage. Okay, let's take a look at BHP, continuing to slip in the early going here in Australia, now off by about 0.2%. And this is going on, of course, after it decided against making a firm offer for Anglo American. It's now walking away from what would have been the biggest mining deal in more than a decade. Bloomberg's managing editor for energy and commodities in Asia, Clara Ferreira Marquez, joins us now. So, Clara, let's get to the Anglo side of the equation in a moment. But first, for BHP, this was going to be a fast way for it to get some more copper assets. What's the plan now?
Well, BHP have time on their hands. I mean, they really, they got so far, obviously. They could not go further without making concessions around structure and price that they were not happy to make. I think shareholders a little bit disappointed perhaps that they got so close to this this big deal and didn't quite make it happen, but at the same time a lot of relief among people we've spoken to that they didn't overpay. And if you remember, mining companies have a very poor track record when it comes to big acquisitions. They tend to get overexcited and destroy a lot of value. So I think the restraint should be encouraging. It does, however, BHP has come out and said that it needs copper so badly that it would go ahead with this extremely complex transaction. Of course, now what we need to see is what they do over the next 6 months, and when Anglo comes back into play, what happens then.
How precarious is Anglo's positioning at the moment, and how much pressure is there for them to deliver on this restructuring plan? Does that mean that rivals are likely to swoop in?
So Anglo, I think we will see a bit of a pause in the fighting. We will see BHP obviously has to stay away for 6 months, but Anglo have this self-help plan that they have to carry out. It is a very difficult plan. They have deals to carry out that do not have obvious buyers. So some of the businesses that they want to sell, De Beers, the diamonds business, for example, and to resolve the issue of Anglo Platinum, to sell met coal, so metallurgical coal used for steel. These are not very easy assets to sell, and certainly not with very obvious buyers. So they have and it's going to take time. So they're in a very precarious position where they need to show progress, but it will be very difficult. If they do not show enough progress, you can be absolutely sure that every single one of the large mining companies will be looking at them once again. And indeed, even if they do show progress, they will become a copper and iron ore focused company, which in itself will become a lot more attractive.
And we've seen this return of the mega miners to hunt for deals, right, after years on the sidelines. Does the fact that BHP chose to walk away rather than continue to negotiate or sweeten the deal, does that reflect maybe a new degree of caution when it comes to how they deal with shareholder reaction?
I think that's certainly what the management of BHP would like to project, and I think that's what will be encouraging some shareholders today. As you said, 10 years ago, there was a huge amount of value destruction. And in the sort of race to catch up with the production needed for China, we went way too far, both in terms of greenfield and in terms of acquisitions. And I think today what we're trying to assess, and this deal perhaps is a little bit of a hint, is can they, this time round, with the energy transition and the demand that we're seeing down the road, can they be a little bit more restrained? At the moment, the signal is yes, but it's early days.
Our managing editor for Energy and Commodities in Asia, Clara Ferreira Marquez there. Still ahead this hour, we're live from the Asia Tech Summit in Singapore, where industry leaders are gathering. Annabelle Droulers is at the event. And Belle, what's in store?
Yeah, really great crop of interviews coming up in the hours ahead, Heidi. But kicking off with the first one just in the next 30 minutes or so, it's going to be with one of the co-founders of Daybreak. Now, Daybreak, for people that are unfamiliar with it, it's a cloud-based platform and it works with large data sets. It also helps companies perhaps build their own machine language models or machine learning models. So we're going to be speaking with that company this hour. Again, as we said, pre-IPO stage, perhaps valued around that north of $40 billion mark. Also ahead, interviews with the US FCC, talking about the tech regulatory scrutiny we're seeing in the US on the likes of big media, also Netflix, telcos and more. Plus, we'll hear from Singapore's Senior Minister of State. So great lineup, Paul, this morning.
All right, thanks, Belle. Coming up next, we're going to speak to Link Asset Management CEO George Hongchoy about their full-year earnings and the outlook for real estate assets in Hong Kong and the Chinese mainland. That exclusive up next. This is Bloomberg.
Link Asset Management, which runs a Hong Kong-listed Link Real Estate Investment Trust, has reported an 11% jump in annual revenue, although net property income fell just short of analyst expectations. Let's talk about all of this with the Executive Director and CEO, George Hongchoy, who joins us exclusively in the Hong Kong studio. George, great to chat with you. Give us, I guess, your thoughts on how these results came through and what were the biggest challenges during this period?
Well, there's a lot of macro headwinds. Obviously, retail market recovery has been slower in Hong Kong and China. But we have been very lucky to have the assets in Australia and Singapore. Both of those group of assets have done very well. We have also managed our capital and hedging and balance sheets well enough to protect ourselves against interest rate increase.
The Link REIT's Hong Kong retail occupancy was actually quite interesting, a record high of 98% in March. Do you see kind of retail headwinds coming from Shenzhen competition, and what are the strategies to try and maintain this share?
The Shenzhen leakage has been headlined in the media and also a lot of the analyst coverage. We think that it is manageable for us, mostly because we have community shopping centres, really people come for daily necessity. So the portfolio itself has been quite resilient. I think the big picture for Hong Kong, apart from people going to China, what we're lacking is that the government have not reversed the change in the policy to allow people in Shenzhen, for example, to come on a multiple visit visa. Until that policy comes back to reverse to where we were before 2018, where we had the peak in retail and tourist spending, that will take a while for our recovery to come.
Can you give us your views on, I guess what you've seen in terms of this go north trend, right? We're seeing people heading more towards Guangdong province and spending their money there. Has that had a big impact in terms of Hong Kong businesses and retail?
Yeah, it is part of Hong Kong becoming part of Greater Bay Area. It is a desire for the government and the region to integrate more and for people to travel to become more porous. And as I said, it has been a little bit more one way for us going up and less of people coming down. So I think that's something that we need to encourage the government to change. But otherwise, I mean, this is a long-term development that will continue. As a owner of shopping centres, we need to make sure that there is continued footfall. The shopping centre need to be interesting with the right tenant mix. With that, then shoppers will continue to come. And I think that's a strategy that we have continued over the last many years and continue to protect us with a very high occupancy with a lot of tenants' demand.
Have you done anything to reposition yourself in that regard? Because I know you've also recently bought Vanke's Mall in Shanghai. Would you be looking to take advantage of more opportunities like that, particularly as a number of developers engage in necessary fire sales?
The portfolio remix has continued. We'll continue to look at ways to recycle capital and also to look at interesting assets to acquire. What I mean by interesting is, they have to come at the right price. Obviously, we are demanding higher return given funding costs have gone up. And to the extent that something like Qibao Vanke Plaza will come along, we'll be very quick to react because we are sitting on a very strong balance sheet relative to a lot of our competitors. We have a team to really be able to deploy and integrate the assets into our portfolio very quickly. So we stand ready to look at different opportunities, and we are, and not just in China, but across the region as well.
In terms of having funding to take advantage of those opportunities, you've got a pretty low debt ratio at the moment. I think it's about 19.5%. If you were to see a reduction in interest rates, how would that impact your appetite for borrowing? Or if rates increase, how would that hurt your DPU growth?
Well, I think we got to a stage where we're talking about high for longer rather than higher for longer. So there is some stability in the financial market. The outlook is that at some point in time, rate will come down, and that's helpful to our unit price and also obviously helpful for us when we look at the cost of capital in our investment. So in the meantime, we are standing in a very competitive situation with a very low average interest rate that funding-wise, because of the rights issue that we have done last year, that has also helped us to have a lot of liquidity, allowing us to be able to withstand what has been quite a challenging market for a lot of property owners, especially in the core and core space which our REITs occupy.
George, do you expect that you've peaked when it comes to how positive occupancy is and retail growth and rental growth more generally? Do you think there'll be more challenges from here?
Well, we have almost fully let assets across all the different property type that we have, whether it's a shopping centre, office and logistics centres that we own. What we would be mindful of is obviously tenants who decide to move on and taste of shoppers changes, tenants not doing so well and they have to move out. And we have, like the past year, 660 new leases signed in Hong Kong. Out of those, just slightly over a third are new brands. Our team continue to be very active in engaging with potential tenants to make sure that there are a long line wanting to come and lease our space.
All right, George Hong Choi, Executive Director and CEO at Link Asset Management. Thanks so much for joining us, George, there in our studio in Hong Kong. Now, you can watch us live and you can see our past interviews on our interactive TV function, TV Go. And there you can also dive into any of the securities or Bloomberg functions that we talk about. You can also become part of the conversation and send us instant messages during our shows. This is for Bloomberg subscribers only, and you can find it at TV Go. This is Bloomberg. A top Israeli official thinks Israel's war against Hamas will continue until the end of the year. The comments come as the US says a fresh ceasefire deal has been offered. Bloomberg's Michael Heath joins us for more on this. Michael, end of the year. Patience is already running thin with Israel's remaining allies. Can it hold out that long?
Yeah, I mean, you can only imagine how isolated Israel would be by that stage if that is the case. But truthfully, that does sound like a more realistic assessment of what it's going to take. I mean, the focus on Rafah now, but the southern city of Gaza. But what's happening is Hamas militants are turning up in other places that Israel has already been through because of these tunnel complexes they've got and their ability to move with the civilian population. So it's not going to be they just go to Rafah and this is all done. I think this is probably more likely a more realistic scenario, put it that way. And for Prime Minister Netanyahu, this is the sort of thing he was after as well, because the longer the war goes on, the longer he's in power, the more chance he has of rebuilding his standing with the Israeli public, which is not fantastic at the moment. So I think that there's quite a confluence there. From the US side, of course, they obviously probably didn't really like hearing that, and they're pushing very, very hard for a hostage deal, which in fact Israel has signed off on. So it's really just coming down to what happens with Hamas there on that side. But yeah, I mean, I think we're going to see protracted fighting.
Well, these ceasefire talks have gone really nowhere to this point. In the meantime, there's an interesting forum happening with Xi Jinping meeting leaders of Egypt, Bahrain, Tunisia, UAE as well. Clearly, this conflict is going to be top of the agenda. What do we expect? Because we have seen China, not just here, but also with Ukraine, occasionally kind of float, their world vision of what a ceasefire, what a resolution might look like.
Well, with Ukraine, I think, China's just too closely aligned with Russia to have much standing there, but they really do have a lot of potential here in the Middle East. I mean, part of the problem with Europe, with the US connection with Israel, is all this legacy stuff from 50, 60 years, the post-colonial period, Israel's formation, all of these wars that have taken place, whereas China comes in with a fresh slate and with, potentially a lot of investment on offer, economic relations. It doesn't get wound up about human rights issues or anything like that, which suits a lot of governments in the Middle East as well. So it really potentially has a role to play. But at the end of the day, when it comes to the Israel-Palestinian conflict, Israel is the key point here, and the US is the key player when it comes to that. So while there might be a meeting of minds in terms of what should be happening in the Middle East, Israel has to be a party to any peace process or anything going forward, and China's capacity to influence Israel is going to be limited there.
And going back to this idea of the timeline for this conflict, we've talked a lot about what happens afterwards. We're not really sure. There doesn't seem to be a great deal of preparedness for reconstruction and whether a two-state solution is even still possible. But is there a sense that this has dragged on for longer than perhaps Netanyahu has expected? Has there been more resilience in the opposition?
Yeah, I mean, the ability of Hamas to withstand this, I mean, Israel's fighting forces are some of the best in the world. So their ability to withstand it is really quite amazing. I think it's been more of a surprise to the defence forces rather than Netanyahu. For Netanyahu, the longer the war drags on politically, that's helpful for him. But for the Israeli forces, they did mobilise a lot of people. They've demobilised a lot now. They're looking more at the precision side of it. But the ability of these guys to withstand it, I mean, obviously they do have tunnels through to Egypt. Israel says now it's cut some of those as well. But yeah, they've obviously got a huge amount of weapons and storage. They're still occasionally able to fire missiles into Israel as well. So yeah, their ability to withstand such devastating firepower is really something to behold. And I think just one other point to make on this 7 months idea as well is that potentially that puts a bit more pressure on Hamas as well, that when Israel's sort of suggesting that it'll be there for the long haul, it does perhaps encourage Hamas to look at a ceasefire perhaps a bit more seriously than it had before.
All right, Bloomberg's Michael Heath there on the Israel-Hamas conflict. Still to come, we're live at the Asia Tech Summit in Singapore with the co-founder of analytics software maker Daybreak. We'll discuss their outlook on AI as well as their IPO plans next. And we're going to leave you there with some live pictures of Iceland. This is the Reykjanes volcano currently erupting there. The scale of this is something to behold. The meteorological office saying lava shooting 165 feet into the air from a fisheye 2 miles long. More in a moment. This is Bloomberg.
Right, take a look at how we're tracking so far this Thursday session. Pretty lackluster. We had a weakness in the handover from overnight, tracking those USPs lower. Yields continuing to climb, and in fact, not just across treasuries, but JGB yields, Australian yields as well, all putting quite a bit of downside pressure across asset classes more broadly, including, as you can see, in equities, mirroring those declines that we saw overnight. That weak sale of treasuries again reinforcing the concern about what higher yields will continue to do. The Nikkei 225 down by close to 2% at this point. The Kospi also showing a little bit more muted weakness, if you will, despite some pretty decent tech earnings that we saw overnight. We're not seeing a great deal of positivity being reflected at all. This deepening rout in global bond markets is really sucking that risk appetite more globally out of these markets. Aussie stocks are down by about 0.7%, Paul. And we've got some pretty notable kind of, idiosyncratic stories that are trading today.
Yeah, we do. It's an interesting stock-specific day for Australia. Let's take a look at BHP, for example. That's off 1.5%, been sliding all morning. And this is, of course, after with 1 hour to the deadline, BHP said, nope, we're done, walks away from that bid for Anglo American. Just too complicated, so that 5-week saga coming to an end. It would have been the biggest deal in the mining space in a decade and created an absolutely enormous company, but it's not happening. Take a look at Sony, off by 0.8%. Bloomberg reporting this morning that Sony's a Queen fan. In negotiations to buy Queen's back catalogue for $1 billion. Right now, Sony's showing a little bit of softness there. Good day, though, for Australian beef producers, because we're hearing that the last remaining Chinese trade strike against Australia, or one of the last, this is on a few abattoirs, could be about to be lifted. So we're seeing that lift sentiment for some of those big Australian agriculture names as well. Let's have a look at the airline space, because we did, of course, hear from American Airlines Group a little bit earlier. It's slashing profit and revenue expectations. Top executive saying that, well, we misjudged domestic demand heading into the crucial summer travelling season. That sentiment having a bit of a knock-on for airline stocks around the Asia-Pacific as well. Got Asiana off by 1%, Korean Air off by 0.75%. A little bit of softness for Japanese airlines as well, Heidi.
And Paul, the Asia Tech Summit, Singapore Summit begins today, one of the region's largest such events. More than 400 speakers, 1,000 sponsors and exhibitors. Let's get back to Singapore now. Annabelle is with our first guest.
Thanks, Haidi. Yeah, joining us now is Arslan Tavakoli-Shiraji, co-founder of Databricks, and we were just discussing there. Okay, so this is a company that is data and it's AI and it's bringing it together. Yep. Thousands of customers around the world, but can you just give us an example of one in particular, and also how the company really works in practice?
Yeah, look, so you could take kind of an interesting example, Adobe. Everybody knows Adobe as a company. What they're trying to do is, most people think about them as Photoshop, but now they have all these customers, creative professionals that are trying to go and drive insights. They want to know, what are our customers doing? How do we give them better capabilities? How do we help them reach their customers? That's tons of data that they have to bring together and then figure out how do they use all sorts of different things, from regular analytics to kind of the latest machine learning insights. That's a lot of work to stitch that together. Databricks says we could do that for you end to end, help you unlock a whole set of new capabilities that you didn't have before, cheaper and faster than you did. And so we have over 10,000 customers globally who are doing that.
You've been around for more than 10 years now, because you're established in 2013, but how do you think the introduction of tools like ChatGPT has really changed your business? Do you think there's a greater awareness of the kinds of things you can do, even if you already have a lot of other things besides large language models?
Yeah, I think it absolutely has. I think the bad joke that I have is we've always been the data and AI company, but previously we had to scream the data part and whisper AI, because AI was considered this futuristic thing. Now the problem is everybody's screaming AI and we're like, don't forget about the data part. So I think what's happened is, where we previously had to convince people data and AI was important, now we're getting calls of saying, how do I move faster on this? And so it's really accelerated. People understand AI is critical. Data underpins it. Without good data, you don't really have AI. And so the demand of people saying, how do we move faster? What are the best practices? What are others doing? We've seen a huge accelerant as a result of it.
And so do you think, though, that focus on AI and just the amount of hype around it, is that what sort of compelled you to bring your own AI tool into the market?
Well, look, we've had an AI tooling way before kind of LLMs or generative AI was there. But I think that the key part is we are, maybe because, we jokingly are Berkeley hippies. We've always been big on open source, right? Open standards, giving people choice. And one of the things we saw initially with generative AI was you kept hearing about these large proprietary labs who were building it. But we thought the future had to be open models. People could customize it. People could take with them both for control, security, costs, and the like. And so we made sure that we basically put out models so that there was a vibrant open source ecosystem. And it's been great to see, in addition to Databricks and DBRX, you have other ones like Mistral and Meta with Llama 3. So there's a lot of now choice. And I think open models are going to be at the core of the future going forward.
Yeah, that's a really big distinction to make perhaps between proprietary versus open source. When it comes to the amount of parameters that you're setting as well, is that something that's sort of the future of where we go from here? Because it seems like really we don't have the sort of compute capacity, we don't have the energy power as well to sustain these really large proprietary models.
Yeah. Well, look, I think it's also, we get enamored with simple things. And the latest one is how many parameters do you have? You have 500 billion parameters. You have 1 trillion parameters. Honestly, it reminds me of the old days where everybody would argue who had the faster Pentium chip for your computer. It's not really the bottleneck. And even if you look at many of these large models that they say there are 1 trillion parameters, underneath there are a bunch of smaller specialized models that you're picking for it. So I think we're now seeing many more organizations go to this model where they're saying smaller model, bespoke for my actual need that I can use. And the key thing, people start caring about how fast can I answer questions and the cost. Because those big models are very general purpose. They're generally slower and they're very, very expensive, not just to train, but to answer questions with. And I think that's prohibitive for a lot of people. So state of the art, in Databricks is at the core of this is how do we drive down those costs and customization with smaller models that are much more accurate than maybe some of these big models for specific use cases.
Let's talk about the business of Databricks. You were last valued at around the 43 billion mark.
Yes.
Is that what you're at today?
Well, we're a private company, so valuation is always weird. And that was the valuation at our last round.
When was that?
Honestly, that's a good question. It's about a year ago, I think, or a little bit less than a year ago at this point. We always get asked when we're going public. I think what we like to say we're fortunate is, when we raised that round, we made a certain set of bets to investors about here's how fast we're going to grow, and we've seen us to not only hit those targets but exceed those targets. So we're just about excited about where the business is.
IPO, though, listing, what would be the timeline for that?
Yeah. It's a great question. We get asked that on a regular basis. I think what we've said is we're not one of those companies who plans to be private forever. And I think we plan to be, kind of go IPO soon. But we're also under no pressure. Many of the reasons you go IPO is, can I get access to liquidity? Do enterprises know who we are? That isn't a real challenge for us. And with things like GPT and, GPUs and LLMs, being private has given us an ability to invest and leapfrog many others that would have been more difficult if we're public. So we'll go public soon, but not in a rush to do so.
Can you give some more insights on what soon means? Are you talking within this year?
No, I would doubt that it would be this year, but honestly, it's one of those things that there isn't this secret master plan on a wall and we're just not sharing it. We've said when the timing is right, but we're much more focused on how do we drive the business.
Okay, and you have seen really strong revenue growth as well. Are you at the point where you're profitable now?
So I think seeing us, as a company, we're continuing to get more and more efficient. But, I think that the crazy part is when you look at some of the numbers that we've shared with investors and analysts, we're still basically growing at over 50% year over year, north of $1.5 billion in ARR. There's pretty much no other company out there that can point to those kind of growth in numbers and continually getting more efficient. So I think that that's why when we talk with investors, they're pretty excited about the state of the company, and we think we're just at the start.
What's next then? What are the new growth areas that you're looking at in particular? Or would you be looking to add further headcount, for instance, any specific regions that you're looking at for that?
We actually never slowed down growth. We're still investing heavily, particularly on the R&D side, because we imagine ourselves being an innovation machine, and on the go-to-market side, because we still think that there's so much coverage. APJ in general tends to be a very fast-growing region for us. We're, investing as fast as we can in terms of headcount across the spectrum. From a growth perspective, we continue to put out new product lines and capabilities. For example, we weren't in data warehousing as an area. It's just been in 2 years that we've kind of released a data warehouse. We're now well north of 300 million in ARR in that area, and we keep adding new capabilities. And the nice part is we don't have any heavy concentration on depending on a couple set of customers. And even in some of our largest customers, we're still a relatively small share of wallet. So we're not close to saturation. So new capabilities, lots of new customers, and even our existing customers, still lots of room for growth.
All right. Really exciting stuff, and also really looking forward to any more updates that you can share on those listing plans. But that was Arslan Tavakoli-Shiraji, their co-founder at Databricks, Paul.
And Annabelle, Droulers there in Singapore. Thanks very much. And Arslan was talking there about some of Databricks' customers. One of those is Grab. And we're just hearing that Grab has signed an agreement or reporting a collaboration, at least, with OpenAI. This is to use OpenAI tech for mapping and customer support as well. And this should enhance its mapping and customer support capabilities. Grab, of course, the rideshare giant in Singapore, Malaysia and other Southeast Asian countries. Now, we're going to have more coming up at the Asia Tech Singapore event as well. You can catch the US FCC chair, also Singapore's Communications and Information Minister, at the times that you see there on your screen. Plenty more to come on Daybreak Asia. This is Bloomberg.
Take a look at oil prices, pretty steady at the moment. A little bit of softness there across New York crude and Brent crude there, but still holding more or less steady after that retreat that we saw on Wednesday. Some of that broader risk-off sentiment offsetting the heightened tensions that, of course, we continue to watch across the Middle East. It is that OPEC Plus supply meeting on Sunday, and interestingly, Stand Chart analysts saying that some of these short positions may have accumulated sufficiently to actually prompt moderate extra steps from OPEC Plus producers. So we are seeing speculative shorts in Brent at the highest since November 2020. So that could kind of be enough of a standout to represent a target for policymakers at that meeting. In other crude-related news, Bloomberg has learnt that Saudi Arabia is preparing to formally launch a secondary offering of shares in oil giant Saudi Aramco as early as Sunday. Sources say the share sale could raise over $10 billion, as bringing in our senior energy reporter Stephen Stupczynski. So, Stephen, what do we know?
We know that this could happen quite soon. It looks like they're shopping this around, and some investors from the Middle East and Europe are showing some interest, and the value will be about $10 billion. Put that into context, the first initial offering by Aramco share sale was about $30 billion, and the company is worth trillions. So they're selling down very small pieces of the company. But they're doing so because Crown Prince MBS, as he's called, wants to use this money to fund other things. He's looking at AI, tech, tourism, other developments that kind of shift the country away from mainly an oil-dependent economy. And so that's why he's kind of dipping back in. Share prices for Aramco of that initial IPO are down about 10% so far this year, I think. You got the chart up here next to me. But offering, again, maybe that's another way to kind of boost the amount of money that they have, the amount of capital that they have, so they can look to diversify further away from crude.
Stephen, sticking at the oil space, we've also heard ConocoPhillips going to acquire Marathon Oil, a $17 billion deal. I was struck by the comments of the CEO, Ryan Lance, saying we weren't necessarily out looking for something, but it was an opportunity that presented itself. That is quite the impulse buy at $17 billion. Could we expect to see a bit more of this?
Yeah, I mean, listen, this has been a pretty what would you call it? This is a trend that's happening within the shale space. A lot of people are trying to see, how can I expand my footprint in shale? How can I find new wells? How can I get older wells and refract those to get more oil potentially out of it? So you've seen that with the likes of Chevron and Exxon, especially since, they had big winnings. They had huge profits. They're sitting on a lot of capital after the energy crisis over the last few years, when oil prices jumped up above $100 and gas prices as well. So looking, how can we use that money? And when they're essentially taking a bet that this oil and gas demand, it's here to stay, right? I think around the COVID times there was this discussion about peak oil demand. That discussion has really evaporated, and people are saying, how can I pump more, and how can I pump it cheaper? And shale is one great opportunity. I think the really interesting thing about this deal in particular is Marathon Oil has a lot of older shale wells. So it's not a play by Conoco to buy up new acreage. What they're doing is part of this strategy called Shale 2.0, where they get these older wells, which were used with sort of inferior hydraulic fracturing technology. Now you can kind of go back to those wells and refract them with kind of a newer mix of water and chemicals and sand to get more output out of there. So it's kind of a way of revitalizing it and getting more oil into their portfolio. It's fascinating, and it's not a trend that will end probably anytime soon. M&A is hot in this area.
All right, senior energy reporter Stephen Stapczynski there. Latest corporate stories that we're watching. Activist investor Nelson Peltz has reportedly sold his entire Disney stake. This is according to CNBC, citing an unnamed source. Peltz's Trian Fund Management last month lost its bid to obtain Disney board seats. Trian controlled Disney shares worth more than $3.5 billion. Bloomberg has learned that Sony Music is in talks to acquire Queen's music catalogue. It includes hits, of course, such as Bohemian Rhapsody. Sources say Sony is working with another investor on the purchase, which could total $1 billion. Earlier this year, Sony acquired a half interest in Michael Jackson's catalogue for at least $600 million. Heidi.
Take a look at what we're watching across Japan, Paul, and we're talking about the pressure that these bond yields have really been putting on other asset classes, including namely equities, and that's really playing out when it comes to Japan. We're seeing that big move when it comes to the 10-year yield rising to 1095. That is a higher since July 2011, and we are seeing this on the back of Treasuries extending that slide, that trio of pretty dismal US debt auctions, creating some pressure. On our MLive blog, interestingly, there's some chatter about how bond yields in Japan are rising now fast enough to present potentially a risk to Japanese stocks. It's already starting to show up with equities falling, of course, middle of this week, yields climbing to multi-year highs. A lot of speculation that there'll be another Bank of Japan rate hike at this point. 10-year yields have risen in each of the past 4 years, and we saw that big increase of 34 basis points in 2022. That's also the only year that we saw a decline in the topics as well. So it is a question of, how much of that push higher in yields we could see equities really be able to withstand as they did across those other years. This year, yields are already up 46 basis points, so this is really seen as kind of a danger zone for stocks as well. So an interesting way to kind of look at this as we see that big push higher for the 10-year yield to the highest since 2011 for JGBs. That yield on 2-year notes we saw for Treasuries rising on Wednesday, pretty close to that 5% mark last reached on May 1st. So that is certainly one of the key trading themes that we're watching, the impact of the move in yields across the equity session. You can get more on Bloomberg Radio too, the day's big newsmakers, in-depth analysis from the Daybreak team there. We're broadcasting live from our studio in Hong Kong. You can listen in via the app, Radio Plus, or BloombergRadio.com. This is Bloomberg.
Didi's net loss grew in the March quarter as higher marketing costs and losses on its stake in EV maker Xpeng outweighed a revenue boost. For more, let's bring in China tech reporter Sarah Zhang. Sarah, there's been some changes at the top after a pretty rough few months for Didi. How's the outlook looking?
Exactly. It was a little bit of a mixed bag in their latest earnings. We saw that revenue was up 15%, but they recorded a bigger net loss than they did last year. And that's primarily, like you mentioned, because of the market value loss in their equity stake in the Chinese EV maker Xpeng. And they have been going through a little bit of change at the top recently. Their co-founder, Jean Liu, stepping back as president and board director after almost a decade and stepping into a role called permanent partner. We saw yesterday that also on the board, she was replaced by the CFO, Alan Zhuo.
This is broadly, Sarah, of course, a story of a former national champion now striving to rebuild itself after a lot of restructuring. Does that mean we're going to see a renewed push towards that IPO?
Yeah, I mean, I think that's something that investors are definitely looking towards. We have been seeing sustained recovery in their domestic sales and domestic business. And so it will just remain to be seen whether or not they'll be able to get the kind of valuation they want when it comes to a renewed bid to relist in Hong Kong.
Does this kind of feel, I guess, for companies like Didi, like we've reached the end of the regulatory pressure and we are now in an environment, given the weakness for the economy more broadly, where there'll be more supportive measures?
We have seen more broadly that regulatory curbs are easing, that pressure on the sector and the private sector more broadly is easing, but it remains to be seen whether or not this will be favorable for overseas listings. We heard from the Chinese regulator that they are supportive of overseas listings, but we'll have to see whether or not they will actually be able to approve and greenlit some of these bigger, more high-profile IPOs like the one from Didi.
Sarah Zheng there, our China tech reporter on Didi. Take a look at how the futures sessions are shaping up at the moment, and we've been talking about the impact of these rising yields on equity sentiment, and that is really a sea of red that you are seeing. US futures looking like will extend those losses that we saw on Wall Street overnight with the weakness really spurred by the soft demand for Treasury auctions there, of course. We are seeing a little bit of downside pressure when it comes to trading in Taiwan, as well as when Chinese stocks across Greater China come online as well. Although we could see that sort of reversal given that those A50 China futures are looking pretty flat at the moment. Dollar China is one to watch. Of course, this resurgence of dollar strength, Paul, has created potentially on the one side that sort of benefit of export-friendly weaker yuan for policymakers, but we know too much weakness is not what Beijing wants to see either. But this is far from just an issue for China.
Yeah, let's take a look at the currency space as well. Of course, in focus, once again, the yen. And the yen is the subject of the Bloomberg question of the day today as well. That question being, well, what happens when the yen hits 160? We're some distance off that at the moment, sitting there at 157.50, but it is around this level that those conversations around intervention inevitably begin again. We have some uncharacteristically hawkish rhetoric coming out of the BOJ. Certainly a move from the BOJ would do a lot to put a floor under that currency. Also keeping an eye on the Kiwi today, because we will get the budget out of New Zealand. The details of that will be revealed in a little bit over 1 hour's time. The deficit in New Zealand expected to come in at $5.7 billion. We are anticipating the potential for tax cuts. Well, that could be inflationary. The government says it won't be, but obviously that would have implications for rates in New Zealand and the Kiwi dollar as well. The Aussie there right now, that is 66 cents. Had a pretty good day yesterday after CPI figures beat, putting tightening back on the table for the RBA. We'll just have to wait and see what happens in that next meeting that's happening in mid-June. That is it from Daybreak Asia. Markets coverage does continue as we look ahead to the start of the day in Hong Kong, Shanghai and Shenzhen. China Show up next. This is Bloomberg.